Hello and welcome to the CNBC-TV18's Mumbai Newsroom. I'm Sonal Bhutra and you're watching MF Corner. Today we are going to talk about value funds. They have generated a return of 7.4% this year. So far it has been a good performance. So to discuss the fund's performance, is there more steam left? We have with us Shweta Rajani, who's the Senior Vice President and Head of Mutual Funds at AnandRathi Wealth. Shweta, thank you so much for joining us today and to discuss all about value funds. And of course, we'll be taking some queries from our viewers as well. They have been writing to us. So thanks a lot for joining us today. And as I said, value funds this year have given a return so far of 7.4%. This is opposed to 2.4% by diversified funds. In what scenario does this really happen? Also, are the internals as strong as the headline number is indicating?
Sure. Thank you, Sonal. So you rightly mentioned that value as a category this year clearly has been one outperforming category, if I have to say so. But that's generally not the way value funds behave. So, there are certain pockets where value funds will do better than your diversified fund, or what we call as the growth-oriented style of funds. So if, I just go back in history and I see from 2018 onwards, 2018-19 were years where you had, let's say, 20 to 30% of the value funds delivering alpha. The average alpha that the category delivered was a -8 or a 10%. So what we have seen is when you have a market which is, let's say, a neutral or a bear market cycle, value funds tend to underperform, and the growth style of investing is actually doing well. But from 2021 onwards, we've kind of seen a reversal in this behavior, where 2021 and 22 were years where the market delivered very good returns, and this was mainly contributed by value funds actually doing well. So this rally has been a value-driven rally. In fact, if I just break up the universe, you rightly said that the headline number is 7.5% of an average return. But if I break it down further, if I have 19 value funds, there would be only 5 funds out of which have actually done better than Nifty. So, that ratio is basically 50% of the universe doing well. But overall, as a category, yes, this time around, we've seen that doing better than, the other categories or wherever there is a growth biasness.
Okay, so yes, the internal's not that strong. There are certain segments which have done well, and the headline, of course, has outperformed this time around. So if we want to understand more about value fund, what exactly are the constituents of a value fund? What kind of stocks or sectors are included here, just for the benefit of for our viewers?
Sure. So, here first, let's just understand what is a value style of investing. Now, when I say a value fund, it is basically a fund manager who is investing in companies which are trading at a value which is below their intrinsic value, or they are trading at a valuation which is lesser compared to their peer in that particular sector. Now, how is the intrinsic value basically computed? You will look at the business model of the company, the financials, the environment, or the sector dynamics in which the company is operating. There are various ways in which a value fund manager will identify a value company. Most common ways are if the company's PE multiple, price to earnings ratio, is trading below its intrinsic value, or it is trading below the peers in that sector, then you call it as a value company. PB, price to book value, is another common measure for identifying a company, whether it's value or no. Few other measures that are used is something like, your market cap to sales, or your EV to EBITDA. Basis this, you'll invest in majority of your portfolio would be in value companies. I'll give you one example. Within the oil and gas sector, for example, the sector PE would be at 20 times plus, but you'll have a company like IOC which is trading at a 9 or a 10 times PE multiple. So that's a value stock within the oil and gas sector. Let's go back in 2021 or late 2020. You had a lot of PSU banks which were trading at a PV multiple which was below the category average. So those were value companies at that point of time. So, what would be the constituents of a value fund? It's not a specific sector which is value, but within each sector, you could have these value picks.
Okay, so wherever there is value emerging, so to say. So in that case, Shweta, can you tell us if these funds are cyclical in nature, and if there are any risks associated with it, what should investors be looking at?
Sure. So these funds are definitely cyclical in nature. And like, when I started the conversation, I said that when we've seen markets to be neutral or, in a bearish kind of a mode, that's when value doesn't perform well. And most often than not, when you're seeing an upward or a growth, upward cycle in the market, value plays out. So it is very important that you understand what the market trend is, what the macro economy is indicating, to understand whether this is a value cycle or a growth cycle of the market. The second important risk, or I would say a point to note, would be the fund manager's stock picking capability over here. Because you're doing your sector selection. Within that, you're then also seeing which is that company where there could be a PE re-rating, that could play out. Because what you're betting on here is that the stock is trading, let's say, at a 10 PE when the average has been 15 or 20. So expecting that the PE multiple will improve, and that's where your uptick in the returns would come. So, so the fund manager's capability here also plays a very important role. Timing your exit at the right time, because it is cyclical, would become the third important point.
Oh, it would, exactly. And that takes me to my next question. Of course, a fund manager's capability is what really matters here. So in that case, what kind of investor should really be looking at such funds? Is it the right time to enter or not? What are the considerations in this case?
Sure. So, what kind of investors should invest in it? Investors who are willing to take a little higher risk or go a little aggressive on their portfolio can definitely have value. Investors who understand the macro trend, or either they understanding it or they have an advisor who's telling them that this is either a value oriented market or a growth oriented market, can definitely look at having a value fund in their portfolio. So actually here there are two options. Either an investor can go for a pure value fund, or go for a diversified fund which is also following a value style of investing. There at least you are leaving it to the fund manager to switch his style of investing from value to growth when the cycle plays out. So that can be another alternative for someone looking at having a value theme in the portfolio. Talking about whether this is a good time to be in value, I would say that from 2021 onwards, we've seen that it's a value driven market, and looks like for the next few months we could see value doing better than growth. So yeah, this is a good time to have some portion of your portfolio in value. But few points that you will need to note here when you are picking up a fund. You should check whether the fund manager's stock picking capability, how is that being compared to his peer. One measure for you to identify whether the fund is really value or no. Check the PE ratio of the fund, and if it is significantly lower than the category average, or the benchmark that it is benchmarked against, then that's a value fund, and you are getting what you wanted in the fund. Look at the risk measures of the fund, like a standard deviation or beta, and then take your investment decision.
Okay. So Shweta, in that case, if a person is looking at all of this, gets a good fund manager, what do you think is the maximum investment in value funds? How much should they allocate here?
Sure. While there's no precise formula to say how much should be in value, but my recommendation would be that you can have 15 to 20% of your portfolio in value. And just to repeat, it could be through a pure value fund or through a diversified fund, which is also following a value style. Like an example here would be an HDFC Flexi Cap fund. It's a Flexi Cap fund, but follows a value style of investing. So both put together, you can have around 20% of your portfolio.
Okay, 15 to 20% of your portfolio. Shweta, that was definitely a masterclass in value funds and investment in value funds as well. For now, we'll step into a short break, but you stay tuned. On the other side, we'll get all your MF queries answered by our expert here on CNBC TV18. Stay tuned. Welcome back. You're still tuned into Mutual Fund Corner on CNBC TV18, and we still have with us our expert Shweta Rajani from AnandRathi Wealth to answer all your mutual fund queries. Well, Shweta, we have received a handful of them. So let me go across to the first one. We have Shantaram writing to us from New Delhi. He's talking about doing an SIP of around 12,000 rupees per month in 6 funds. We are getting the details of those funds such as Axis Mid Cap, ICICI Nasdaq 100 Index, Axis Small Fund, HDFC Fund. So a whole host of funds where he has invested. He wants you to review the portfolio and advise any changes if there are.
Sure, Sumit. So, 12,000 rupees per month is the SIP amount. If I just give you a rough idea that, looking at the historical average, if this grows at 14%, what would mean is that over a 10-year period, you could have accumulated a 30 lakhs kind of an amount in the portfolio. Coming to the specifics now, for the schemes that you have shared, I have a couple of observations here. One is right now our view on the Indian equities is positive, and I'm not so positive on international equity. Specifically US. When you look at the growth potential for India, you look at the corporate earnings expectation, as well as when you look at the valuations, India is far better placed than US. So two of your schemes. One is clearly a Nasdaq ETF that you have. I would recommend you to exit out of it. The other fund, Parag Parikh Flexi Cap, also has a significant exposure to US equities. So I would recommend you to exit that. Another fund that you have in the portfolio is a banking and financial services fund. And what happens is here again, because this is a sector you are taking a timing call, it would mean that you have to understand when that sector cycle will play out and exit. Also, what happens is in a normal diversified fund, 30% of your portfolio is banking because the index weight in that sector is 35%. So then your sector contribution also increases. So that's the third fund I would say that you should exit. Axis Small Cap that you have is a very good fund. Mirai Emerging that you mentioned is again a very good fund that you should continue holding it and continue your SIP as well. But the other funds, Axis Mid Cap again has been struggling for quite some time. I would suggest you exit that. What you can add is instead of an Axis Mid Cap, you can have a Kotak Emerging Equity Fund. You can have an iProve Focus Equity Fund in the portfolio. And you can have, if you want another small cap fund, you can have a ABSL small cap, you can have an HDFC Flexi Cap and an iProve Focus in your portfolio.
Okay, so that's a wholesome reply actually. Thank you for clarifying that, Shweta, for our viewer. The next one is coming in from Arun Dash, who's writing to us from Mumbai. He deposited SIP of 5,000 rupees per month. That's the contribution that he's making from 2014 to 2020 for 6 years in ICICI Blue Chip, and then he stopped thereafter, and he wants to know the accumulated amount is still in the fund. He wants to know if he should exit the fund, he should stay. What should be done by Arun Dash? Shweta?
Sure. So one thing here, I am not too sure if this is your entire portfolio. I'm guessing it's not your entire portfolio. So at this point of time, I don't have clarity on ICICI Blue Chip is what percentage of your total portfolio. Generally, I would not suggest you to have more than 15% of your portfolio in a single scheme. You need to spread out your scheme risk, basically your fund manager risk, your AMC risk, as well as your category risk. So if it's just 10% all of your portfolio and iProve Blue Chip, then you can have it. Then you can continue with it. Otherwise, I would suggest you to redeem your allocation from that and again spread it all across different categories like a Flexi Cap, Focus, Mid Cap, Large and Mid Cap. My preference within the ICICI group would be instead of an iProve Blue Chip, an iProve Focus Equity Fund.
Okay, so diversification is the key. I hope that answers Arun Dash's query as well. Moving on to the next one, Gaurav writes to us from Hyderabad. He wants to build a portfolio with 4 funds to diversify rightly. 2 large cap funds with 30% fund allocation in each, 1 mid cap with 25% fund allocation, and 1 small cap with 15% fund allocation. He wants recommendations of 4 suitable funds with a goal of long-term wealth creation. Shweta.
Sure. So, Gaurav, you've mentioned 3 categories of funds: large cap, mid cap, and small cap. What I would suggest is instead of having 3 categories, have 7 categories of fund in your portfolio. You mentioned 30% and 2 schemes in large cap. Now, we've done a study to mathematically see which category has a higher return potential and an alpha potential over Nifty 50. And large cap is one category which has the least return potential. So if I have to give you some numbers, large cap as a category in the last 4 years would have outperformed Nifty 50 by an average 2.82%. It has 90% underlying as large cap stocks. You have flexi cap, which also has 75 odd percent in large caps, but the alpha that it's delivered is around 5.5%. So instead of having 30% exposure to two large cap funds, I would suggest you have 10% exposure to a large cap fund, have one flexi cap and a large and mid cap fund. Likewise, you said small cap. Now, small cap is a good category to have. It has good alpha potential, but the risk also tends to be a little high. So instead of putting 25% in one small cap scheme, I would suggest you have a multi-cap fund and a small cap fund. Your small cap fund exposure not going beyond the 5-7%. Mid cap, you can have a 25% allocation. So, that's in terms of category allocations that I would suggest. Schemes that I would suggest within each of this would be that you have a Franklin Blue Chip, you have an Aditya Birla Small Cap, you can have an iProve Focus, HDFC Flexi Cap, and you can have a Kotak Emerging. And if you want to have, a slight aggression or an unconventional theme in your portfolio, then an SBI Contra too.
Okay, those are a lot of options, and thank you for directing to the specific ones for the investor, Shweta. To the next one now, Satya Balakrishnan writes to us from Tamil Nadu, wants to know and wishes to invest 5,000 rupees through SIP for long-term investment. Please advise her where she can actually invest.
Great, Satya. So, my response here would be very similar to the previous query, where I would say that you need to focus on having the right categories in your portfolio, right number of schemes, so that you are not either too concentrated nor over diversified, as well as have certain hygiene factors like not going beyond 25% of your portfolio in a single fund house. So here again, I would suggest you to have, a mix of, let's say, a Franklin Blue Chip in the large cap category, a DSP equity opportunities in the large and mid cap category, an HDFC Flexi Cap, a Kotak Emerging, an Invesco Multi Cap. So you can have, 5-6 of these funds and construct your portfolio.
Okay, and we are getting queries from across the country, so that's good to know. Bipul Sharma is writing to us from Madhya Pradesh. He wants to invest in mutual funds for a long time horizon, and it is of 20 years to receive 1 crore rupees as return. Please suggest some funds. Well, I would have to say, Bipul, that's a very specific return that you are looking at. That's good to know. Shweta, in a situation like this, what would you suggest?
Yeah. So, your requirement, one thing is very good, is you're very clear of your goal. You're looking at 1 crore at the end of a 20-year period. So this helps you work backwards to see how much you should be, saving or investing every month to get to that goal. I'll just use the historical averages, and, if I look at equities, they're able to deliver a 13-14% return. And to get to, let's say, 1 crore after 20 years, you'll have to invest somewhere around 8,000 rupees per month, 8 to 9,000 rupees per month. So if you do that, then you will get to your objective of 1 crore after 20 years, assuming a 14% return, which is a reasonable expectation. What you should have for this 8,000, again, it may sound a repetition, but it is very important to have the right categories and, the right categories, the right market cap in your portfolio. So I would suggest you to, again, have a Franklin Blue Chip, a DSP equity, an HDFC Flexi Cap in a proportion that you will have 50% towards large cap stocks, 35% in mid cap stocks, and the rest, 15-17% in small cap. So you can also have an iProve Focus, a Kotak Emerging, and ABSL small cap, which will give you that mid and small cap exposure to your portfolio. With this kind of a balance, you'll be able to have a consistent return with 1-2% alpha over a Nifty 50, and risks being managed because you have a blend of all the market caps.
Oh yes, it's a balanced approach, Shweta, for the question that we just got. To the next one, Brito Sebastian is writing to us from Goa. He wants recommendations for 3 mutual funds to invest 2,000 rupees monthly in these funds. Shweta?
Yeah. So, here again, Brito, if you have another portfolio, then, apart from this, then I'm guessing you'll be fairly diversified. But if it's only this investment that's going in, then you have 1/3 of your money in a single scheme, which I would not be comfortable with, 15 to 18% maximum in a single scheme. So here again, I would suggest instead of having 3 schemes in the portfolio, have 5 or 6 in the portfolio. So that the best of fund managers can go through their down cycle. And when that happens, you don't have 1/3 of your portfolio not performing for you. You may have a 10 or 15% of a portfolio if you have spread this across 6 schemes. So my suggestion is 6 schemes with equal allocation is what you can do. You can have, again, the names remain pretty much same what I've been talking about. DSP Equity, HDFC Flexi, Franklin Blue Chip, a Kotak Emerging, an SBI Contra. Those are the schemes you can consider.
Okay, a lot of queries is what you've received. Shweta, thank you so much for answering all of them for us so patiently. I'm sure all the viewers definitely benefited from that. And with that, it's curtains down on this edition of Mutual Fund Corner. Do write to us if you have any queries, and stay tuned for Closing Bell to take you through the last hour of trade.